Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 199th VideoCast, 189th podcast for the week ending August 10th, 2023. Welcome. We've got a lot of great stuff to cover this week. First, I would like to thank Phil Yin and Dalal Pektas for having me on CGTN America Friday night. We're going to go into that right now because it goes through market overview, jobs report, and a new stock pick. We went through Disney, which we covered a little bit last week, but we know this week after earnings, the stock's up quite a bit, and we believe just beginning that journey. So let's go ahead and listen in.
For more about the jobs and the economy, we're joined by Thomas Hayes, founder, chairman, and managing member of the Great Hill Capital. Good to see you again. You know, if this was a week ago, I would be clapping my hands, celebrating what an amazing bull you are. But this past week, I feel like the mood has changed a little bit on Wall Street in the sense that we're getting these numbers and everyone's trying to look for this negative angle on each of these data sets. And today was a good example, right? We had the jobs numbers, the markets rallied, and all of a sudden, somewhere in the middle of the day after lunch, the trader says, we don't like it. What happened?
Well, I think the most important thing that happened with this jobs report is it gave the Fed more cover to skip a rate hike in September. And you saw it in the Fed funds futures, assigning a 12.5% probability of raising in September. So that's good news. Then you looked at the inflation numbers in recent weeks with PPI nearing deflation at 0.1% and CPI at 3%. We're going to see some new data next Thursday, as Karina alluded to. That's going to be important. But I think the key thing here is, you know, last month before the revision, you had the lowest job growth in 19 months. I mean, with these numbers, you're probably over 2 years, the slowest jobs growth. So the Fed can kind of skip and allow more data to come in. Even the JOLTS report was down this week. So I think the good news is it's this perfect situation where the economy is going well enough, but the inflation and the labor is soft enough that the Fed could actually skip and be more and more data dependent.
So why didn't Wall Street like the, I mean, what's with today's reaction that ended up so negative? And this week, quite frankly.
Today had nothing to do with the jobs report. It was all about Apple. Apple's down 4%. It's a huge weight in the S&P 500. The market didn't like the outlook for Apple. Services were good. Handsets were a little bit weak. And you've got Apple trading at 33 times earnings with 7% earnings growth. Of course, it has to take a break. You couple that with seasonal weakness. August and September, as you know, are among the worst months of the year. However, institutions missed the first half of the year rally. That's evidenced by their positioning and their cash. So I think any of these seasonally weak pullbacks, 3%, 5% pullbacks, are going to be aggressively bought. And those folks that missed the rally that are looking for a 10% correction are going to be waiting for a long time.
Some are talking about this flattening of the yield curve, right? You have short-term rates that are high, or higher, and then you have long-term rates that have recently kind of perked up above this 4% level. And some people are making a big deal about it. Explain to us why we should watch this, if at all.
Okay, well, the guy who invented this indicator was out on public media within the last 6 weeks saying that this time is different. So the guy who invented the indicator said, don't pay attention to it. But the most alike period that we can look to for the inflation hiking and the steep aggressive actions by the Fed is 1980 to 1982. And you had an inversion and then you had a reinversion, just like we had in 2020 an inversion, 2022 a reinversion. But by that time in 1982, the market was already rallying and it never looked back. And if you look at earnings, earnings are now coming in much better than expected. It's a redo of Q1, where estimates were expected to be negative 7%. They came in at negative 2%. As of today, Q2 earnings were supposed to come in at negative 7.3%. They're now at negative 5.2 with 21% left to report. So we'll finish, call it negative 4, negative 3. The key is analysts were too pessimistic and they have to take up estimates. And you're seeing it for 2024. They took them up to $246 for the S&P 500. That's good news for the economy.
Thomas, I absolutely love your optimism, which is why we love having you on the show. So let me get this straight. You think that, not you, but the market thinks that they're unlikely to raise rates come September. The jobs numbers is generally positive because it shows the economy is healthy. Earnings, as you say, are coming in better than expected. So I'm just going to lay it out there. You're bullish, and you're telling us we should buy stocks going into the end of the year. And if so, where?
Specific stocks. I wouldn't chase the indices. You had 18% ups the first half. That's not going to be replicated. We're looking for mid-single digits for the indices, which are weighted with the Apples of the world, which have to take a breather. The Magnificent Seven that led the first 5 months are going to take a breather. We like other stocks that haven't moved yet. We like Mickey Mouse. We like Disney. The parks are reopening in China. Everything's getting back in action. They've got the best content library in the world. They've got the best parks in the world. And by the way, the stock has only fallen 50% 3 times in the last 30 years. 2000 to 2002, it fell 60%. The great financial crisis, it fell 57%. And in the last 2 years, it's fallen 58%. You get a chance to buy one of the best properties in the world at 50% off. This doesn't happen very often. We think over the next 12 to 24 months, the stock can be up 50 to 100%. Iger's going to right the ship. They've got the content library. They'll add some bundling. They'll add some ads to the bundling. The parks will be humming, and China will reopen, and they're off to the races. So we like Disney.
You're making my kids real happy. I think each of them have like 1 or 2 shares, so we'll have to buy 1 or more. Real quick before you go, I know you've liked China stocks in the past. They've had a fairly big hiccup. It's been, for some people, a disappointment, but for others, if you got in the right time, you made money. Do you still like Chinese stocks, and if so, which ones?
I love them more than ever. Alibaba, the cloud, is just getting started with generative AI. The compute power demand is unlimited. They're going to spin that out. They're breaking it into some of the parts. The Chinese government is going to do aggressive stimulus in the back half of the year. They've said as much, and we're going to start to see it. They want to bring down youth unemployment. They want to grow the economy. They're going to do all of those things, and Alibaba is going to be the toll taker, the major beneficiary of that growth initiative. Remember, they've only been open for 6 months. It's getting started. You're seeing Wyndham was out this week saying how good things are happening in the last 6 weeks in China. Starbucks was out. Nike, we're going to see the numbers. MGM China. So all the companies reporting are saying, wait a second, the last 6 weeks, things are starting to hum in China. And you couple that with some stimulus, you couple that with being the greatest property in China in Alibaba, we're off to the races. So yeah, Alibaba's up 20 points in the last few months. That's just the beginning in our view. Over the next 12 to 24 months, this is going to be a lot higher.
Thomas Hayes, Great Hill Capital, a bull. You like China. You're buying. Good to see you. Have a good weekend, my friend.
Thanks, Phil.
And we're back. So that's kind of the overview to kick us off. The next thing, I want to thank Kim Githler, Mike Larson, Debbie Osborne, Aaron West, and the whole crew over at The Money Show. I went out to Las Vegas to speak at the conference on Tuesday. It was phenomenal. Many great speakers there. This was the opening reception, and you may recognize from Fox Business, Charles Payne, Making Money with Charles Payne. Of course, Kenny Polcari is always on, Keith Fitzgerald, many others, Mike Lee, Mitch Rochelle, so many names that you know. It was just a phenomenal time. Larry Williams was there, the technician, and Tom DeMark and Tom Lee, which was great to see. So we're going to go ahead and listen in. What I've done, and this presentation is very important, it's called Why Emerging Markets Will Outperform Developed Markets Over the Next 12 to 36 Months. And the volume, we're going to increase the volume here, so you should be able to hear it just fine. But also, if you can't, what I found is if you just crank it up, it was done in a very large auditorium. I think there were probably a total of, 1,000 people there. This was just for accredited investors. And but the message is key. And what will also help you hear it perfectly is if you go to the article of the week, Vegas Baby Vegas, stock market and sentiment results, scroll all the way down, and you could either follow along these key slides. So when I'm talking, you can see the slides that you can't see on the screen in the video, or click here for the full slide deck. But that will make it very easy to understand what I'm saying. And there's some great Q&A at the end. So we are going to listen in right now.
I'm delighted to have Thomas Hayes join our family. He has not been one of the regulars, but we're hoping he will be. He's going to chat a little bit about something that's near and dear to my heart, because John Templeton is one of my dearest friends when he passed, but he opened my eyes to the emerging market world through Mark Mobius, who many of you know, and we also work with. But this gentleman is going to talk about why emerging market equities will outperform developed markets over the next 12 to 36 months. I like that. Thomas J. Hayes is the founder and chairman and managing member of Great Hill Capital, a long-short equity manager based in New York City. Before starting his own firm, Mr. Hayes worked with Cornwall Capital, one of the firms featured in the Big Short book and movie. He publishes his timely stock market commentary, Hedge Fund Tips with Tom Hayes, VideoCast and podcast on a weekly basis. He has a wide following in the investment management, hedge fund, and media community. Please give a warm welcome to Thomas Hayes.
Everyone's been sitting for a little while. Let's get a little energy going while we stand up for a quick second. And I find these events are really valuable, mostly for networking as well. So I'd encourage you, turn to the person to the left or the right, say your name. Hi, I'm Tom, I'm from Connecticut, and what you do. And while we're doing that, how many of you, is this your first Money Show conference? How many of you are coming for multiple years, more than 3 years? Yeah, I met some people last night who've been coming to this show for 10 years, 20 years. This is legendary. So I want to thank Kim, I want to thank Aaron, I want to thank Mike, I want to thank Debbie and the entire crew for putting on such an incredible conference and inviting me to speak here. So let's give them a hand. So we're going to talk about emerging markets. Hands up who has exposure to emerging markets right now. Okay. Hands up who, after seeing the China trade data this morning, is excited about China. Crickets. Okay. I couldn't have picked a better day to do this presentation, but I think by the end of the presentation, you're going to find that there may be some opportunity. It's just looking past kind of the windshield and looking to the future, 12 to 36 months out, and the opportunities that are there. So we're going to talk a little bit about history to get some inkling as to what might happen moving forward. This is opinion, not advice, all the natural disclaimers. So let's see, there we go. Green is big green, there we go. So, basically, we're a long-short equity manager. We run separately managed accounts for accredited investors and qualified institutions. And we've really developed a reputation over time for profiting from periods of dislocation, okay? Whether it was tech and semiconductors, if you remember just a short while ago in the fall of last year, you couldn't give away semiconductors, you couldn't give away tech. Whether it was the pandemic lows when energy was trading at negative prices. So we like to run into the movie theater when people are running it out, when someone has yelled fire, but we think there's actually not that big of a fire. Or if there is a fire, it can be put out relatively quickly and relatively safely, and we can benefit. And that's not always easy, right? You know, when everyone's going the other way to be kind of the lone soldier or a small group of people, I think very similar to the small group of people you saw who were bullish in the fall of last year. Tom Lee is one of the speakers that was here. There were a handful of us that were pretty constructive on markets when it looked really, really grim late last year. And we also have a website where we post weekly research. People find this very valuable in the sense that it has a large following in the hedge fund community. And we do our weekly podcast, which is called Hedge Fund Tips with Tom Hayes. It is ranked #1 by FeedSpot in the hedge fund category, and that's free for you to benefit wherever you get your podcasts, or also on YouTube. We view our confidence in dislocation when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk that has actually come out. Who feels like when a stock or the market or a sector falls pretty dramatically, oh, that's extremely risky? Everyone feels that way sometimes when the stock's down 50%. Oh, that one's got a lot of risk. But the ones that are going up or have already gone up tenfold or 15-fold, everyone says, well, there's no risk there because it just keeps going up. It's safe. That's where I'll put my money. And that's kind of the real opportunity in markets over time. If you can look past the short-term volatility and take advantage of these opportunities, that's where you can make big money over time. Now, you're going to hear a little bit about where I cut my teeth, and it's going to start to make more sense why I think in this way when it's not very common. So I have 1.5 decades in the hedge fund industry, predominantly long-short and multi-strat funds. You heard from Kim, I have Great Hill Capital. And who saw the Big Short movie? Okay, so I work for Ben Hockett. He's called Ben Rickett in the movie. He's less handsome in person than Brad Pitt, the actor who played his part, but he's probably a lot smarter, one of the smartest people in the business. And they were focused on esoteric derivative strategies with a value tilt, and we had a tremendous relationship together, and we still talk pretty regularly. So. And then in the fund before that, not only was I assigned to generate ideas for the portfolio and public securities, but one of the portfolio companies in our portfolio was kind of struggling, and the head of the fund said, I'm putting you in as chief operating officer of the public company. I want you to go in, sell off all of the non-core assets, take the cash, and buy an asset manager. And I was like, okay, boss, I'll go ahead and do that. Public company COO, I could hardly tie my shoes at the time. But what was interesting about this exercise was over the next 12 months, I interviewed over 100 different asset managers, institutional managers, financial advisors, RIAs, some household names. And what I was able to do is look under the cover and find out which businesses were durable over 5 years, 10 years, 15 years, 20, which stood the test of time, which strategies were pop and drop and they didn't really last, which companies continued to compound and build their clients' capital. And what I came to the conclusion of was that there was always some underlying value mindset in the companies that did well over the long term. And the growth companies were more volatile and less reliable in terms of predicting their cash flows in terms of the business. And that should tell you something as an investor, that there is opportunity and value, not just cheap for cheap's sake, but cheap when you have an embed of quality in the business. We're going to talk about one example here. So that first fund that I was with was seeded by 3 gentlemen you may know. Mike Bloomberg put up $25 million, Sam Zell put up $25 million, Sandy Weil of Citigroup put up $25 million. So I cut my teeth, and the founder was very good friends with Warren Buffett for 40 years. So I cut my teeth around these guys, going to idea dinners with Lee Cooperman and Marion Ravelli, and going out to the Berkshire annual meetings. And you know Buffett's philosophy, be greedy when others are fearful, be fearful when others are greedy. And right now, would you say people are greedy about emerging markets in China or fearful about emerging markets in China? Do you think that will stay that way forever? This time is different, it's never going to come back? Or do you think that it may come back and there may be some catalyst for that to happen? The latter. Okay, good. So we're on the same page. So this is emerging markets. This is a long-term chart of emerging markets. And what you can see going back to the 90s, there was a long-term period, multi-year period of sideways consolidation. Okay? No one wanted emerging markets. Why would you be in emerging markets when you could be in .com and you can buy eyeballs instead of businesses that actually generated cash? But that changed, and then what you saw immediately following that from 2002 to 2007, about 450% rally in the indices. And the indices are valuable, but what's more valuable is when you have a move like that, you you have companies and stocks that are going up many multiples of that. So the indices are up 20%, you can have companies that are going up 50%, 100%, and a lot more. And the same thing is true with emerging markets. And what we see right now is emerging markets have basically done nothing in 15 years. Okay, they've been grinding sideways, they've been consolidating sideways after a 450% move. There's been no opportunity. If you look at that peak in 2007, it's very, very close to where we are right now. And we think the stage is being set for a similar move to 2002 to 2007. And we're going to talk a little bit about why. The thing about that is, when something's been consolidating for 15 years, we're not going to be able to tell you which day or week it's going to turn and permanently go straight up. But if you set your sails, you can be carried away as the wind picks up and as the rally comes through. We do think that there are a couple of key factors that you have to keep in mind to take advantage of this. Number one, the most important thing is the US dollar. And the US dollar is critically a function of the Fed policy. And it's not just the absolute Fed policy, it's the relative Fed policy. So it is our view that the Fed is done or near done. Okay, maybe they have one more hike, maybe they have two more hikes. Our bet is they have zero more hikes, but it's really immaterial if they have 0 or 1. The key thing is, just as we started before most central banks in the tightening process, we are going to be finishing before most central banks with our tightening policy. And what that means is, on a relative basis, emerging markets and non-US currencies are going to be going up relative to the US dollar. And when that happens, emerging markets tend to flourish. When the dollar's been going up and it stops going up, it sets the stage for massive rallies in emerging markets. So, the first thing I want to point you to as we look through here, the red lines there is the emerging market chart, just like we showed. The black line in the background is the US dollar. And then we're going to talk about two simple indicators on the top. Who has ever heard of the most complex, sophisticated indicator called RSI, or relative strength? Okay. Is there anyone that's new to today? No one. Okay, so let me just share my experience from being in this business for a long time. The more you zoom out with these indicators, the more valuable they become. Okay? So if you're doing it on a 1 minute, you're going to get chopped up on it until the cows come home. If you're doing it on a 15-minute, good luck. If you're doing it on a daily, maybe you start to have some slight edge, okay? But everyone's looking at the same indicators. What no one's doing, and I was telling a friend today, I'm in the time arbitrage business. If I buy quality and it's on sale, I'm just playing the waiting game until that intrinsic value is realized. Now, with these indicators, you got the RSI, you got the MACD. What this is showing is that there's only been 5 times that the RSI has been this low. It's gotten below the 30 level on a monthly chart since the mid-90s. Okay, we just hit one last fall. Remember when everyone was super pessimistic and Alibaba hit $58 and emerging markets was in the toilet? You can see it on the chart. That was one of those times. So it's starting to come off the boil. The second one is the moving average convergence divergence. After the RSI hit this extreme level of 30, and you saw the red line cross the black line, that's what we call a crossover, it confirmed that more likely than not, the worst of the scenario was already in the rearview mirror, meaning the lows in the emerging market index were probably in the rearview mirror. Is it perfect? No. Did it work 4 out of the last 4 times? Yes. Okay, but it's a small enough sample size that we can say, well, maybe this time's different, you know, Xi Jinping and yada, yada, yada. But we're of the view that the most important factor, besides those indicators as they relate to the emerging markets, is the US dollar. And in all of these instances, you can see the common denominator with the vertical blue line was that the black line started to roll over. You can see that dollar strength, and then it rolled over, and then you got 131% rally in emerging markets in the late 90s. Then, if you look in the early 2000s, you can see that the dollar peaked all the way at the top of the chart, that black line. That was the absolute bottom in emerging markets before you had the 450% rally over the next few years. Then you had 2009, 2010. You can see that black spike in the dollar was the bottom of emerging markets.
dollar rolled over, and then emerging markets rallied. We had it again in 2016. Dollar peaked in black, started to roll over. Emerging markets had a 91% rally. And the exact same thing happened last October. The dollar peaked. How many of you recognize that? You saw the dollar peaked in October. It's been weakening ever since. And we've since had a rally in emerging markets ever since. So pretty high correlation and pretty solid stuff. So we're going to move along here. This was our tell. If you go back to our podcast, Hedge Fund Tips with Tom Hayes, bring up the October sessions when everyone was pessimistic. We were talking about the US dollar, and we were using the commercial commitments of traders, which is the Friday report for the CFTC. It showed the green line. We're selling ahead of. Commercials are always early and they're always right. The red line is kind of the hedge funds who think they're the smart money, but are often on the wrong side of the trade at extremes because they're trend followers. That showed us that the dollar was going to start to roll over, and we believe that trend is just beginning, which is going to help emerging markets. Key thing here, demographics is destiny. As we know in the U.S., we've got millennials are now bigger than the baby boomers. The baby boomers 30 years ago were about the same age. That was around 1990. We had a monster rally in the 1990s. There's no instance in 100 years we can find in any country where when the largest part of the population is between 30 and 40, that the economy doesn't and the stock market doesn't do exceptionally well. That's what we have in the U.S. We are constructive, very constructive on the U.S. for the next 7 to 10 years. I think Tom Lee's going to talk about it, and someone else spoke about it as well. This shows the long-term trend. You have 18 years of sideways consolidation, Great Depression, 1970s, 2020s, and then you have 17, 18 years of expansion, which implies, based on age, housing formation, family formation, having babies, buying cars, buying cribs, buying sofas, that we've got a lot more to go. And that could put us in the early 2030s at 14,000 on the S&P 500. Why does that matter? Because the similar demography is in China. So China is the biggest weight in emerging markets. We just went through that. You can see the top holdings: Alibaba, Tencent, Meituan, etc. 40% of the emerging markets index. And China's population-based demography is now in that sweet spot. Okay, so what people say about China's demographic problem is 100% true. In 5 years, they're going to have a bad demographic problem, just like Japan had in 1989. You didn't want to be short Japan in 1985 because they had the biggest rally in the shortest amount of time. We believe we're going to have one more parallel move with China, which is the biggest weight in emerging markets, and that's predominantly dictated by the fact that the larger part of the population is between 33 and 36, and usually those rallies persist until they start to peak at age 40, when their spending goes down, when their housing formation goes down, when their family formation goes down, and that's one of the reasons that we're bullish, and we overlaid it with the U.S. to help you understand. One idea that we like in emerging markets, which is now our largest capital commitment, we have positions that have actually grown much larger in size because they're up 4x in the last year or so. One is an auto supplier called Cooper Standard. But this is our largest capital commitment allocation in our portfolio, not Microsoft. You're going to see in just a second. It's Alibaba, okay? Alibaba has the largest cloud share in China. They're spinning that company off, so they're going to break the company into 6 parts to realize the value in the marketplace. Both the CEO and we believe that the cloud spin-off, AliCloud, is going to be worth more than the entire company is worth right now within the next 2 to 3 years. And we believe that because McKinsey has shown that the cloud business in China is going to triple by 2025, and Alibaba having the largest share, 38%, is going to be a monster. AliCloud today is where Amazon Web Services was in the US in 2016. And following that trajectory, they're going to do another $10 billion of operating income, which would be 60% higher than the entire Alibaba company was doing just a few years ago when the stock was trading at $300. It's now trading at about $93 or $95. This reminds me very much of Microsoft from 2006 to 2013. In those 7 years, remember Steve Ballmer, everyone says he was terrible, blah, blah, blah. Steve Ballmer was actually very good. In his tenure from 2006 to 2013, he grew revenues by 112%. He grew cash flow by 193%, and he grew earnings by 120%. Guess how much the stock went up? Goose egg. Zero. But he laid the foundations. You remember Warren Buffett, in the short term, the market is a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. Over the next 8 years, after he laid that foundation, the stock was up 1,500%. How many of you own Microsoft? How many of you bought it in 2013 after it had gone nowhere for 7 years? How many of you wish you had bought it in 2013 because you had looked at the business and said, wow, they doubled the business, the stock has done nothing, this is intrinsic value, I want to take advantage. And that's what happened. And by the way, for those of you who think, no, Satya Nadella came in and changed the company. Well, over the next 7 years, Satya basically performed the same as Ballmer did in the previous 7 years. He doubled the revenues, he doubled the cash flow, he doubled the earnings. But the difference is, over Ballmer's tenure, the stock did zero. Over Satya's tenure, the stock did 1,500% or 36% compound annual growth rate over those 7 or 8 years. Alibaba is in the perfect setup. Here's the difference, ladies and gentlemen. Revenues are up over the last 8 years, from 2014 IPO to the end of last year. Revenues are up 884%. Cash flow per share is up 502%. Earnings per share is up 507%, and the share price has moved zero. Someone else has experienced all the pain, okay, of getting zero return while the intrinsic value of the business has multiplied. As that volume collapses, as flows move into emerging markets, Alibaba being one of the largest weights, in our view, both from fundamental, secular, and structural reasons, is going to be one of the biggest beneficiaries. The politicians are all the same, whether they're communist or whether they're democratic. They all make the right decisions after they've exhausted all other possibilities, okay? So in the case of China, when you see the trade data numbers, when you see all this stuff, and you say, wow, this is bearish, this is bullish, because Xi Jinping will have no choice in coming weeks but to unleash the bazooka of consumer-led stimulus. Alibaba is the tool taker for that stimulus, and that's why it's our largest capital allocated position. And finally, you can just see the multiples relative to history. The Hang Seng, when it gets down this low, if you buy it, you're ahead of those rallies. Alibaba's average multiple is 23 times. It's trading at 11 times forward. No one wants it when it's down, just like Microsoft in 2013. That's it. So I want to thank everyone for coming out today and listening, and I think we're going to take a couple of questions if needed. Yeah.
Well, can you trust the financials of a company like Alibaba? I mean, to me, I've been burned by the Chinese. They just lie on some of those financials. Yeah,
I think that's a valid question, and that's why when we go into pockets of dislocation, like in 2020, when oil was trading negative, we weren't buying small E&P companies and hoping for best. We bought Exxon when it was in the 30s. We bought Wells Fargo when it was trading at $25 a share. So during periods of dislocation, because you have that risk, you want to buy the highest quality. If there's a problem with Alibaba, the entire country is going to have a problem. But would I be buying small and mid-cap Chinese stocks? No, because it's a coin flip if you can count on it. Alibaba has gone through all of the PCAOB has done all of the studies with regards to the auditors to keep them listed in the US. That was a big thing over the last year and a half, which was an overhang on the stock. That's been resolved now, so we're very confident in Alibaba's. We're not confident in any random Chinese company or Chinese IPO. We'd be a little bit cautious, but very good point. Any other questions? Yes?
Recent recommendation from the last club is Foxconn.
Foxconn. It's a great question. I think it'll probably work. I haven't done enough work to have confidence in that, but it probably has an overhang right now because of the handset business, which will probably re-accelerate it because you had a lot of pull forward. So generally, I'm probably sanguine, but I haven't done enough work to comment, and I think that's a great question to pick. I'm going to check it out. Yes.
End up destroying the economy. What makes you think she is different?
100%. So here's the core difference. Like I said, okay, the question is what makes you think a dictator won't destroy the economy? The number one job of a politician is to get reelected.
okay? And what you saw in COVID is, do you remember the Chinese were locked down 2 years longer than everyone else, and they were actually like soldering people in their apartments so they couldn't leave if they had COVID. And then something changed overnight. And what changed overnight was you had a bunch of people rioting in the streets. And all of a sudden, Xi Jinping said, my power is at risk. If you want COVID, you can all have COVID. And literally within 24 hours, they opened the economy, there were no more restrictions, and miraculously COVID died in 4 weeks. Like, you know, you had a little restrictions, but it was just like, you want COVID, you go have it, but I'm not gonna lose my power. The people have spoken, they're rioting in the streets, he was afraid of Tiananmen Square, and they opened right away. They've only been open for 6 months, they're getting their sea legs, and the next phase is you got 20% of youth unemployed in China. The last thing you want is educated, angry, young people that don't have jobs. And sooner or later, whether he proactively does the stimulus bazooka or reactively, if we see a situation on the street again like we did with COVID, the bazooka is coming. The key is what is the catalyst. So he has dictator power, but it's limited by the fact that people's willingness to tolerate pain until they revolt, and then he has to make the change. And our bet is we're at that point now. Yes?
What are your views on India at this point in time?
I love India. We're going to take all the money we make in Alibaba and we're going to be buying India in 3 to 5 years. Here's why. If you look at the demography, and we're constructive on India, period. It's gotten a little ahead of itself. But the demography of India is about 5 or 10 years younger. The biggest portion of their population, about 5 or 10 years younger. So I think it's a little early days in terms of really getting aggressive in India. There will be one-offs to do. But I think your thought process is 100% correct. We are watching it. We're looking at individual companies. We just think China is now, based on the age of their population, and some of the catalysts that are in place. Thank you. You're welcome. Anyone else? All right. Well, thank you so much. I'm very grateful to have been here. Mexico has been strong as a bull. I mean, the offshore. I think that their currency, along with many of the emerging currencies, are going to continue to appreciate against the dollar. I'm very constructive on Mexico. I think it's moved a lot. So we like to be in when no one wants it, and right now people already want Mexico. People are seeing the opportunity in Mexico, so it's kind of run away from us a little bit. We want to get in on the ground floor before the takeoff, and I think Mexico has already taken off, and I think it's going to continue to flourish. But yeah, great question. I like that. Yep. All right. Thank you. And we're back. So that kind of puts it in perspective and reminds you of why we love Alibaba and gets you present to. You know, it's interesting. I was thinking about just today, what would you do? And we covered the beach ball analogy in that speech, but what would you do if you owned a package of 500 apartments and they were worth I don't know, $30 million, let's just say. And every year, the rents kept going up. The free cash flow kept going up. But for some reason, no one was offering you 30 million. Some people were offering you 15 million. Some people were offering you 25 million, but no one would come in at 30, and maybe it was worth 60 million in a euphoric market. But the underlying business, the cash flows kept improving. If you're a wealthy person, you know that all you'd have to do is wait till the market got hot again. And if you wanted to lay it off, you could probably lay it off at 80 or 100 million when everyone got super excited and cap rates were compressed to 1 or 3%. But the panic people wouldn't understand. They say, wow, the business keeps improving, but no one's offering me 60 million or 75 million. Maybe I should sell. Maybe they know something I don't. No, they don't know anything you don't. That I can assure you. If your cash flows are going up, you hold the asset. And it's no different with ownership of companies, whether they're public, private, real estate assets. If the underlying business improves, you hold it. Sooner or later, just as the market's under offering you based on the intrinsic value and the increase of the business, they will be over offering you at some point, and that's when we will help them out and say sold to you. But we are a long way off, and I think we're going to get there a lot sooner than we think. As I said with Charles, next stop's 120. We'll hit a little resistance there, and then once we're through that, I think it doesn't let anyone in till 180, and then we'll go from there. But looking at earnings, here were some of the highlights. Revenue was up 14% year over year. If you would look at the daily trade data and nonsense that you see every single day with the headlines out of China, deflation, disinflation, and yet Alibaba's revenues are up 14% year on year. Their income from operations were up 70% year over year. Their adjusted EBITDA 32%. Their net income attributable to ordinary shareholders was up 48%. Their diluted earnings per share 48%, and the free cash flow, the only thing I care about, was an increase of 76%. They generated $5.3 billion in free cash flow, and that is the name of the game. Now, if we look sector by sector, we can see Taobao and Tmall was up 12% year on year. Their International Digital Commerce Corp was up 41%. That's going to be a new pubco. Their local services and logistics was up 30%. Their Kainao Smart Logistics was up 34%. The Cloud Intelligence was up 4%. We're going to talk about that. That's obviously a key part of the future. The Digital Media and Entertainment Group was up 36%, and all others were up 1%. Every single thing was up. Stock was up 4 or 5% today in the face of the headline of the executive order from Biden that you can't invest in private equity and VC can't invest in Chinese companies or something to that effect. But if you read through it, there's a carve out for public companies coming. And that's why the K-Web was up in addition to Alibaba earnings. So sans that headline, Alibaba probably would have been up 10%, 12% today. But it doesn't matter. The key is the business continues to grow. So the more they keep the beach ball under the water, the more it's going to rocket up all at once. And I think we're there anyway, irrespective of the headline, because that headline has been an overhang for 4 weeks. People have been waiting to see what's in this executive order, and it appears that it has very limited teeth, which is very constructive. Okay, so what I want to do is quickly play a few minutes from the earnings call that related to just the cloud business. All the other stuff is great, great news, rainbows and unicorns. Let's hear the cloud.
During the quarter, Alibaba Cloud revenue grew 4% year over year. The growth rate was negatively impacted by the normalization of CDN demand, as usage of video streaming, remote working, and remote learning came down when offline activities resumed after pandemic measures were lifted. The growth rate was also partially impacted by revenue decline from a top customer. In the past quarter, we have received strong demand for model training and related AI services on cloud infrastructure, which were only partially fulfilled due to the near-term supply chain constraints globally. We believe the growth opportunity driven by AI services have just begun. We believe that technology evolution brought by AI is not a short-term opportunity, but the beginning of a new era. As one of the world's leading cloud service provider, we will continue to invest in forming a full-stack product and technology leadership across IaaS, PaaS, and MaaS layer. This is key for us in capturing AI opportunity and sets a differentiating advantage for Ali Cloud versus other players in China, which mainly focus on one of the layers. We will leverage and expand this advantage when serving the needs of our customers, including training and service needs for large language startups, as well as industry demands for customized models and vertical models. We believe the high performance and the low-cost computing power required for model training and services will open up brand new opportunities for cloud computing services. Over the long term, Alibaba Cloud will benefit from the application of AI in all industries. In the MaaS layer, we have built model scope a leading open source online community in China for models and the related tools and services, which is very popular among developers. The community hosted over 1,000 AI models, including Meta's recently released Llama 2 and our own open source model. The 7 billion parameter version of Tongyi Qianwen. We believe the aggregation and engagement of a model ecosystem will significantly help developers optimize their model and use services on Alibaba Cloud. Since April, we released our own large language model Tongyi Qianwen, audio-to-text transcription platform Tongyi Tingwu, and text-to-image model Tongyi Wanxiang, which together have accumulated millions of users. In this quarter, Alibaba Cloud's adjusted EBITDA reached 387 million RMB, representing year-over-year growth of 106%. This is mainly due to the reduced co-location and bandwidth cost of DingTalk as a result of normalized usage after the pandemic, as well as enhanced product mix and efficiency improvement. For example, server utilization in our cloud business. We will continue to focus on quality of operation. And as we continue to scale up, we will work to achieve economics of scale that will deliver long-term operating benefits and contribute to our profitability.
And we're back. Now, shifting on to the US data, we saw that the probability of a Fed rate hike dropped to 9.5% for the month of September. And that was a function of the inflation data that came in this morning, coupled with the initial jobless claims. So what we're basically seeing every single day and every single week is very clearly cover for the Fed in terms of data, where it would make no logical sense for them not to skip once again doing a hike in September. So here we can look at all the bad Chinese data this week, and yet Alibaba absolutely knocked the cover off the ball. And then we look at this morning, the core CPI came in at 0.2 month-on-month, 0.7 year-on-year, below expectations of 4.8. Headline 3.2, below expectations of 3.3, 0.2% month-on-month. And we'll go into some of this stuff as we move forward through here. This was a chart that I put out over the weekend with our daily reads. This is small cap versus large cap relative PE. And you can see the last time that the multiple got to 0.65 for small caps relative to large caps, the total return over the next few years was 64.82%. And that is a 10.5% annualized return versus the S&P dramatically underperformed during that period. That's from 2000 to 2005 for 5 years. So I think we have a similar situation here, and this also sets up very closely at the same time that small caps were outperforming large caps. Emerging markets had their biggest run ever, which we just covered in the presentation. And I think we're entering a similar period. I think you're going to see both small caps and emerging markets dramatically outperform large caps. And what has been focused on for the last handful of years plus or decade has been the large caps. And I think they're going to take a back seat. They don't have to crash. They don't have to do any of that. I just think you're going to see dramatic outperformance. We're expressed in small caps through Cooper Standard, and we're expressed in emerging markets through Alibaba. And those are both number one and number two positions. So this is from Jay Capel over at Sentiment Trader. I like this chart quite a bit. Financials may be due for seasonal weakness, overbought pullback, but for those of you with long-term time horizon, financial insiders are still buying heavily. So while Moody's is downgrading, the insiders, the CEOs, the CFOs are happily saying, thank you very much. You gave us another bite to buy these stocks. That's what they're doing. And when they've bought this much stock on the inside in history, 6 months later, on average, the sector is up 17.53%. 1 year later, the sector is up over, the median is 33%. The average is 30.3%. Win rate 83% of the time. So ignore financials at your peril. Keep in mind, the small cap index is financials weighted, 21%. So that is in line with our kind of 12-month outlook, 12 to 36-month outlook, small caps and emerging markets outperforming large caps and developed markets. Okay, the next one is from Seth Golden. He says, I mean, if we have an economic surprise index to if we have an economic surprise index to measure how offsides consensus economists' estimates are, why are they required? And basically what he's showing is the Citigroup Economic Surprise Index is showing good things are happening. Economic data is coming in better than expected, and that's constructive despite everyone's still remaining pessimism, as evidenced by cash balances on the institutional side and level of risk that they're taking on the institutional side. Carl Quintanilla put this out. Zillow signed rents are declining. Vacancy rates are rising. Apartment supply is booming. Suggests that further declines in rental inflation are barreling down the pipe. This is from Bespoke Investment Group. And you can see here what's happening with Zillow observed rent versus CPI rent ex hotels. And that will catch up or catch down, as we like to say. Vacancy rates going up on the multifamily, as is huge pipeline of apartment supply. So keep an eye on that. This is also from Carl Quintanilla, and what it's saying is inflation is basically gone when you exclude the lagged shelter, i.e. rent data, which we just covered. Remember, rent is the biggest variable in CPI's biggest category, shelter, and there's a known 12-month lag between asking rents and CPI rents. We've covered that ad infinitum, and that's why we're seeing the softness that we're seeing. The key here is the Fed has all the cover they need to skip again. I think they should they don't even have to say we're going to pause and keep rates elevated. Just say we're skipping this meeting, next meeting's live. They can just keep saying that for the next 2 years. We're skipping this meeting, the next meeting's live. Keep your hand on the throttle, but and threaten the brake, but you don't have to use it. And that will manage inflation expectations. That will keep, modest throttle on things, but it will allow us to recover with jobs and have a good situation turn out. This is from Ryan Dietrich. It says, hard to think things are as bad as they keep telling us with this happening. So third-party collections are at the lowest level in history. So everyone talking about the 1 trillion nominal credit card balances, non-inflation adjusted, by the way, need only look at percent of debt service as a percentage of disposable income and realize the balance sheets are healthier than they've ever been. Here's also from Ryan, shelter makes up 40% of core CPI, stubborn part of inflation, but we're seeing signs it's slowing. In fact, private data shows rents negative currently year on year, like opening the door for much lower shelter prices in the next 9 months. That is a big deal and confirms what we said previously. Forward earnings expectations jump. Look at the surge in expected EPS over the next 12 months. That's what the stock market cares about, not the past. We've been talking about that. And this is beautiful. I love that Ryan put this out because, there were literally only a handful of people that were bullish in the depths of last fall. We were one, Tom Lee, Ryan Dietrich, Seth Golden, a couple others that I'm forgetting, but you know who they are. I've talked about them all the time. And so this was October 17, 2022. Forecast for U.S. recession within a year hits 100% in blow to Biden. So there you go. The most forecasted recession that never came. And then you have from Sonu Varghese, which is Ryan's partner over at Carson. Headline inflation is up 17 basis points month on month, 1.9% annualized on a 3-month basis, and 3.2% on a 12-month basis. Core is 16 basis points on a 1-month basis, 3.1% on a 3-month annualized, lowest since September of 2021, and on a 12-month, it's 4.7. And then he lays out some details by sector. 3-month changes. So you can just see here, everything is giving the Fed cover to move out of the way. This was very interesting. This is from Moody's downgrade. So Fitch did their downgrade, which we talked about on one of our public appearances. And then Moody's said, oh my goodness, we've got to earn our fees. We got to downgrade something. So they decided to downgrade banks. The problem was it was already priced into the market. And the best bank reporter in the business, Carlton English, the only reporter who got this right in July of 2020 during the pandemic lows when we were on CNBC Europe saying that these reserves are going to be unwound and that's all going to come back in earnings. We're big buyers of banks. And that's why she was the only reporter who understood this and reported on it at the lows of the financial crisis. Usually journalists follow, opinion follows trend. After the price is up 100%, they get bullish. She was right in the middle of it. She got it right. She was the only one who got it right. So whenever she writes about banks, I pay attention. And what she's basically saying is, congratulations on your downgrade. It's already priced into the stocks. And consensus estimates. Let's see here. What was the line? All the normal things. Risk cited by Moody's were rising funding costs. Really, you think you just figured that out after they went up 500 basis points in 12 months? Lower regulatory capital on hand. Chance of commercial real estate defaults. Like, you're 6 months late. The panic about commercial real estate was 6 months ago. Did you miss that when the equities were down 90%? Now they're all up 50% off the lows, including Vornado, by the way. Possibility and the possibility of a recession. But thanks for that prescient call. You should go open a fund tomorrow. So we expect a mild recession, funding and tightening conditions. Okay. Yeah, here's her line. Those risks shouldn't be taken lightly, but Moody's isn't telling anyone what they don't already know following the collapse of Silicon Valley Bank and others this past spring. Since then, banks have survived 2 earnings cycles and the Federal Reserve's annual stress test, which helped assure Wall Street of their durability, while many regional banks also opted for intra-quarter updates as well. Wall Street analysts appear on top of this matter, having already cut their earnings forecast for the S&P bank ETF by 16% over the last 12 months and for the regionals by 24%, meaning it's already priced in, numbnuts. Little late on the call, but thanks for playing. Try again. Moving on to Amazon. Amazon stock jumps on earnings. AWS and AI are reigniting optimism. You all know by now from the lows of last fall, we own 2 of the Magnificent 7, Amazon and Alphabet, and those seem to be the ones insulated. Apple looks like it's taken a little bit of a break, and some of the others. So this is the cloud's coming back. You heard from the management at Alibaba about the future of the cloud, and basically they're just going to give out tons of compute power. They're going to sell the AI service apps on top. They're going to mint money. And they're going to be off to the races. So very excited about that. The overhang, by the way, I didn't want to spend a half hour going through the whole thing, but just go to investor relations and pull the earnings release. But they still have overhang from their largest customer, TikTok, unwinding their US server exposure to Alibaba. Why? Because they have to put it all on Oracle to appease the US government for all the US back office. So that will be a continued headwind until they're completely off, and then it will be a hockey stick upwards as the comps year on year start to roll without them. Now, what Fed officials have been saying about rates this week, Patrick Harker said in a speech Tuesday the central bank could be near a point where they can hold rates steady, and that's in line with all the data we see coming in, and today helped them with that view. Also with the initial jobless claims, as we covered, I think was 385 or something like that. Then Disney, all of a sudden, they inked a $2 billion deal with Penn National to launch their sports betting business. I always tell people this, quite a few of the people that come to me often have sold their businesses and for whatever they've sold it for, 80, 100, 150. And they come to me and they say, yeah, whatever, I want to put 5 with you. I want to put 10 with you. And I say, I'm happy to do that. Thank you. Let's go. But keep some powder dry, because I see it over and over and over. In 3 to 5 years, you're going to be buying the business you just sold back from the owners after they run it into the ground at somewhere between 10 and 20 cents on the dollar. Well, today Barstool Sports bought the business that they sold to Penn National for $500 million. He bought it back for $1 today. And many of the business owners that I manage money for see the same thing over and over, or those who have just sold will see it in the coming years. So it's pretty interesting to see how there's a big difference sometimes between the entrepreneur who builds a business and the person who stewards it. Every now and then you can find great stewards, but there's nothing like the person who built it themselves. So that was that. PayPal's crushing it. Why isn't the stock responding? This is interesting from actually the Motley Fool of all things. We've said this is a position of ours. And basically, it just says the multiples at historic lows, the business is growing, everything that we've said about it, and we think this time will be no different. But again, after heart attacks, they take a little while to build those bases before you get the doubles and triples, and I think that's going to be the case. I think the first catalyst is going to be when they announce the new CEO. That's been an overhang with Schulman leaving at the end of the year. So within the next few months, they'll announce that you probably get 30 points out of that over 4 weeks. And they'll put out their whole growth initiative. They'll kitchen sink the first quarter, and then we'll be off to the races. So pretty excited for that. Moving along, U.S. jobless claims spiked to highest level in a month. More cover for the Fed. That's a constructive thing. And with unemployment at 3.5%, we can afford, a little bit of upward pressure. Disney stock is rising. Potential spinoffs are in the spotlight. So that's exciting to see. We put that name out, and things are starting to click all at once. Disney's Iger gets second show on the road. Now we move into the China stuff. Tech war. New U.S. investment curves have limited impact on China's targeted semiconductors, quantum computing, and AI. It's basically limited also to private investment, not public. So that came to have less teeth than was anticipated. So that overhang should start to come out of the stock. China, one of Apple's best performing markets in June quarter amid strong iPhone demand, as tech giants' global sales remain sluggish. So everyone's bearish on China, but now you've had Apple, you've had Wyndham, which we covered last week. You have had MGM, you've had Wynn, you've had basically every company saying the last 6 weeks have been off the chart in China. And now more than any of them, Alibaba, we see in the results. Alibaba takes a step forward, comeback as growth finally returns. And on to the article of the week. Vegas, baby, Vegas, stock market and sentiment results. So we went through that. That's they had, as I said, Larry Williams, Mitch Rochelle, Mike Lee, Keith Fitzgerald, Kenny Polcari, Tom Lee, Tom DeMarc, Charles Payne, and so on and so forth. So very exciting. Charles probably signed over 500 books while he was there. He was very kind to do that. That's that. So we covered that. This is the seasonality we've been talking about. Right on target. We got that little chop in early August. Now it looks like we'll probably start to get a little bit more buoyancy and then some sideways consolidation until we hockey stick into the end of the year. But under the surface here, this consolidation, what that looks like is the heaviest weights underperform, and the ones that haven't performed can be rallying massive even while the overhead indices are not doing much. And we've been talking about that since June 1st, and that's what's been playing out. Now, Cooper Standard reported after our podcast last week, was very exciting. As you know, Cooper started as one of our largest 3 positions by capital deployed in May of 2020 and has grown into our largest position through price appreciation. We went public with this name in May, then December, then most recently. And here are the highlights. Sales totaled $723 million, which was up 19.4% year on year. Gross profit was up 405%, or $77.7 million. Their net loss improved by $5.4 million. Their adjusted EBITDA came in at $47.9 million. That was up $58.3 million because they lost money in that quarter last year. And then lastly, net new business awards, $84.9 million, including $36.4 million related to EVs, which, as you know, they make about 20% more per EV car. And then you can just visually see the sales from 685 to 723, gross profit, and all the way to adjusted EBITDA was negative 10.4 last year, plus 47.9 this year. Stock is up, meaningfully from last year's lows. So there you go. Moving along on the conference calls, I want to go through some of these key points. As market conditions and production volumes are improving, we're not letting up on our efforts and commitment to maximize operational efficiency and become as lean as possible. Purchasing teams delivered $16 million in savings through lean initiatives and improving efficiencies. And when you consider SG&A expense, we're pleased to see more than 4 percentage point decline as a percentage of sales. Finally, we're continuing to win new business awards, especially on electric vehicles. We covered that. You can see the bridge here. It was mostly volume and mix, hurt by a little bit of foreign exchange, and then adjusted EBITDA was mostly volume and mix. So, and that's been our thesis since day one. These guys can execute. We had no question, no doubt about their ability to execute. The question has always been volumes, and we had our thesis to why volumes are coming back. 13.7-year average car. Semiconductors would come back. And in an 8% environment with dealers offering more and more incentives and starting to compete on price, we sell the picks and the shovels while they kill each other by flooding the market with cars and fighting on price. And we just smile all the way to the bank selling the sealing systems, fluid transfer systems, and fuel delivery systems. So excited all around. And we went through the sales, EBITDA, the pricing contracts. They basically negotiated transformational negotiation. They were talking last year about shutting down Europe. European was a major contributor because they got the contracts adjusted, and now they're doing well in Europe. So that will keep humming along as a major contributor. And net price adjustments added $209 million versus the same period last year. Talk about management's ability to get those negotiations done just in time. Volume, mix, and net price adjustments added $95 million. Purchasing efficiencies added $24 million. And then liquidity is $230 million, but they said that their cash balance improved materially after the close of the quarter. So that's very comforting. That probably, it takes it up obviously above $230 million of liquidity. Whether it gets it to close to 300 or not, we don't know. But that's a good thing. And then they're guiding to cash flow positive for year end. So then it doesn't become a factor, which is a good thing. We believe there will be cash flow positive in the second half and for the full year. Further, we believe with the cash on hand, expected cash generation. And by the way, one of the analyses that we looked at before they got refinanced was the assets on the balance sheet. They did some sale leasebacks. They have some non-core businesses that potentially could offer liquidity if it makes sense. So there are a lot of other ways, but just the core business and the volumes coming back and the operating leverage will be plenty. But there are a lot of things also, another levers that they can pull if they decide they want to pay down debt faster than they need to. They can take advantage of those opportunities as the markets allow them to. Got that. Earnings. We're continuing to work with all of our customers to recover incremental costs related to inflationary pressures and establish sustainable pricing that will enhance the quality of earnings and value creation in the long term. Having successfully concluded those negotiations earlier this year, our focus is now achieving fair and sustainable pricing that accounts for current input costs, market dynamics, as well as deliver for our customers. Most of our customers have been supportive, and we've successfully concluded negotiations with the majority of them. We saw positive impact in our European segment results for the quarter. Commercial negotiations with customers in other regions are progressing. As John already mentioned, we expect to conclude more negotiations in the third quarter. So as they conclude those, I think what we're going to be able to see, and I said last week ahead of the earnings call, I wouldn't be surprised if they were very subdued in their outlook as they have been in recent quarters, because in the middle of a negotiation, unlike Mary Barra, who was bragging about how much money they were making and the UAW jumped all over it. Well, if you're making so much money, pay us. We want to work 32 hours instead of 40, and we want you to increase our pay by 40%. These guys are a little more astute and, being modest in where they are and where they can go and conservative, setting expectations low and then exceeding them every quarter. And that's what you want to see from a quality management team that can execute. So we're also advancing our commercial efforts to improve cash flow. Our progress to date includes implementation of more favorable payment terms on trade receivables and customer-owned tooling, as well as supplier-funded tooling. We expect these changes will have a meaningful positive impact on our cash flow moving forward. I know they used to front a lot of money to the tooling. I think somewhere, it was a lot. I'm cuffing it, but not 100 million, but somewhere between 50 and 100 million. So maybe they're able to get some of that back. That can be one of the aspects that contributes to more cash on the balance sheet, which is very positive. And we'll consider divesting non-core businesses that don't meet our strategic minimum rates for margins, return on invested capital, or future growth, similar to what we've done before. Our commitment to either fixing or exiting underperforming businesses remain a central part of our strategy to, quote, restore our margins and returns on invested capital to double-digit levels. And that's been the entire thesis. As you get normalized volumes, which, by the way, a couple things I want to say about this, which hit me like a ton of bricks preparing for the Money Show conference, because what I forgot about Cooper Standard, I've been saying, wow, if we can just get back to 85% of 2017 industry car volumes, which seems easy to do because the average car on the road is 13.7 years. We're in an 8% environment, so used cars are toast. Dealers will offer more incentives as the market's flooded with supply as they have the parts in. Because if Ford and GM try to pull off what they did during COVID, limiting supply and jacking up prices, Hyundai and Kia are going to flood the market with $30,000 cars and take all their share. So they're going to have to fight back and load the lots. And once they load the lots, they're going to offer 0% financing. And we're going to keep selling the window sealing, door sealing, fluid transfer, and fuel delivery systems all day long, regardless of how many cars they sell. But what that doesn't take into account, which is very, very important, is the fact that the last time we had this large a segment of our population at age 33, 34, and we've talked about this often in the context of we're halfway through the bull market, which we think goes to 2030 or early 2030s, was the early 90s. And I was talking to some industry people, and the 90s was the halcyon days for auto suppliers because the volumes just kept growing every single year, and the economy was obviously in a bull market. Why was that happening? Well, they were halfway through the bull market from 1982. So from 1992 to 2000, the auto business just boomed. And so while we keep saying, wow, they've taken all these costs, if industry production just gets to 85% of 2017, the company can earn $7 a share. And you put a trough multiple of 10 times, you got a $70 stock. You put a peak multiple, you got a $140 stock. What I'm completely missing the forest for the trees, because the demographics of 2017, you had the largest segments of the population were 27, 28, which is too many years before housing formation, which starts in the early 30s, family formation, when they move out to the suburbs, as they all did during COVID, accelerated, then they have to buy extra cars. Now the work from home gig is basically over. I mean, people are being forced back to the offices. They're going to need the cars. And that's going to continue for the next 7 years. So I don't think volumes are going to get to 85% of 2017. I actually think, based on demographics, with the largest part of our population being 33, 34, I think they're going to get to 115% of 2017 levels. And if that's the case, with the amount of businesses, with the amount of costs that they've taken out of the business, I think we may be being far too conservative about this company. Yes, you have to account for margin of safety, and yes, you have to be conservative, and yes, all that stuff. But I just don't think my numbers sync up. I think they're far too low when I think about, 80 some million millennials at 33, 34. We haven't seen this since the baby boomers were at that age from 1990 to 2000. And then they've got this lean business with hockey stick operating leverage. It's not out of the question this business could earn $10 a share within the next few years. And God forbid, if they start doing that and get a peak multiple, this thing is a monster. But like always, cut it in half again. You still have an exciting story for the next 3, 4, 5 years. So that was a key component that is a critical part of my Alibaba thesis with China, as you heard in the Money Show. And I was completely forgetting it for our largest position, which is Cooper Standard and the millennial age in the US. And that sets up for some really exciting things. Couple that with small cap relative to large cap, multiples, et cetera, and an incredible management team that can execute, and you're off to the races. So, okay, the running shoes, that's just a free option. And they kept guidance conservative for 150 to 175 million of EBITDA. We're not even like 10% out of the woods, and they're nearing half of what they did in 2017, which is mind-boggling. In other words, ahead of schedule. At 400 million, they did adjusted EBITDA. They did $7.19 a share. They got a 20 times multiple, $146 stock. We have a lower share count today than we had in 2017. It's kind of comical that people are skeptical at $20 a share. It's kind of funny, but more for us. Hopefully, this UAW thing will get choppy and we'll have an opportunity to buy more stock. But we just have a hard time buying when it's up 5x or 4x. I guess 4x today in a short period of time. But if the negotiations with the UAW create volatility in the auto sector, and we get the benefit of that with Cooper Standard, and the price comes down, we've got a lot of new money we can put to work and crank this position up and take advantage of what we think is going to be taking place. So very excited about that. Now, here's what Michael Ward says. Okay, so the analyst asks, so in the 25-26 period, if we get back to the levels of production in North America, Europe, China, China's already got North America and Europe, we can expect, operating income or EBITDA north of 300 million or getting closer to double-digit type of margins you're talking about. And the CEO, Jeff Edwards, says, yeah, Mike, you see that, what we believe is that we've done a great job of reducing our fixed costs. Our companies continue to find a way to take the cost down. So as the volumes increase, we clearly expect to see that fall to the bottom line. As I've said publicly several times, we expect double-digit EBITDA, double-digit return on invested capital to be back in our corner over the next couple of years here as those volumes increase. Yes. So in a couple of years, this is 2023. That means by 2025, he's talking about these numbers. I mean, this is ahead of schedule in my book. Maybe I'm too conservative. Next, Brian DeRubio says, just on the guidance, you're seeing slightly better light vehicle production here in the US and Europe, but you didn't change your guidance. It's just your effort to be conservative at this point in time, ? And the CEO goes, this is Jeff. Yes. That was his full answer. So that's all you need to know. So as I said here, we're hopeful that there may be some short-term overhang in the stock until UAW contract is negotiated with the OEMs so that we can put new money to work at a lower price, but we're not holding our breath. I'm not sure at this point, even if the negotiations get sideways and production's going to be shut for a little while, I don't know if we're going to get an opportunity to buy much lower, but if we do, we will welcome it with open arms. We covered the Money Show. Here were the slides again. So if you didn't get them, you can go back and listen. Here's the earnings, beat on the top line, bottom line. We went through all those gains. Sentiment is still somewhat elevated. Fear and greed came down to 67. National Association of Active Investment Managers dropped to 65% equity exposure. So they're getting scared. Okay, consumer discretionary, top 30 weights earnings. Top 30 weights earnings power was revised up in the last 60 days by 5.5%. And 2024 earnings were revised up by 5.15% for the top 30 weights of the XLY consumer discretionary sector ETF. So that's a really big deal. So that's the kind of risk on trade, consumer being back, the safety trade consumer staples, which got elevated last year when everyone was calling for a quote 100% chance of a recession. The cumulative 2023 earnings power was revised down by 2.5%, and 2024 estimates were down by 3.51. So those seeking the safety at the wrong time got burned. And I think we're ready for our Ask Me Anything question section. So let's see what we got here. Zivko asks, hi, Tom. Would you mind sharing your thought on Estee Lauder? Great business all around, high return on capital for decades. Family owns 35% of it. Somewhat a duopoly with L'Oreal. Good part of the business is in airports around the world due to the challenge with travel and cyclicality they suffered the last few quarters, but all seems to be temporary macro challenges and a great business at a discount. Yeah, so the big overhang in Estee Lauder is China. And I've actually looked at the stock and I do want to buy it. The reason I didn't is because we have such an overweight exposure to Alibaba, and we're kind of like, if China works, Alibaba's going to work just fine. We don't need double exposure to China. But this is one we're looking at as new money comes in. It's down from 368 to 169, so basically cut in half. Let's take a look at the business here. So they had peak earnings a year and a half ago at 750. The earnings cut in half, and so did the stock. Earnings are expected to jump back up to 550 next year. The cash flow per share is starting to, again, was cut in half and is expected to recover. Sales dropped, looks like about 15, 18%, and is expected to recover. So a lot of this is China. They also bought Tom Ford Beauty. I wasn't crazy about that acquisition. I thought they overpaid. I thought that guy was going to go on the beach and that was going to be a wasted $3 billion. Probably true. I think this is probably an opportunity to buy a high quality business at a reasonable price. I'd like a little more margin of safety, but I don't know that we're going to get it, and I'd have to study the business a lot longer before I made that clear. The question is, has anything happened to its franchise value? And I don't think so. I think it was just the slowdown, the leftover slowdown from China, which should pick right back up. Let's see here. But yeah, I mean, this has been a historic compounder, historic high quality business. Margins have held up even as sales have gone down. That's probably due to the family's influence owning 35% of the stock, knowing this is temporary because they've owned it forever and they understand the business versus the, people puking out of the stock because they had a bad year due to people being welded into their apartments shut and, extrapolating forward that, you'd get the type of numbers that you get when people are welded in their apartments. So why we haven't pulled the trigger on this, number one, we haven't done all the work yet. But number two, I think it's going to trade very similarly with Baba, and I think there's more upside with Baba. I think this is a China play, more or less. But I like it. I think it's good work. Haven't done anything with it yet. We may start to do some work on it, but I'm not in a huge rush on that one. Dave Perella, love what you're doing. Had a question on the most recent top hated pick, Disney. What do you think the odds are of them partnering or getting bought by a bigger tech name like Apple, Google, or another major company? And what would a future like that hold for Disney stock? Keep up the hard work. I mean, Apple could buy them. They won't. I don't think anyone's going to buy them. It would be like a $300 billion purchase because they'd have to pay at least 100%, 50 to 100% premium. I think they're fine on a standalone basis. Iger's fixing it at record speed. There was the thing, he's doing AI in every sector to cut costs, increase productivity. He's raising prices. He's doing password sharing, investing in the parks, cutting spending on movies that don't work. Bringing in, did the partnership with Penn National to get a betting partnership with ESPN, which sets the stage for them to possibly spin it when it becomes twice as profitable. So everything's moving in the right direction on that. Gregory Brink, curious on CargoJet, Canadian-based company that provides time-sensitive air cargo services to all major cities in North America. Management sees acceleration of e-commerce adoption from COVID-19 as well as shift to wide-body narrow aircraft, which has reduced belly capacity. Two key positives for CJT long-term. Peaked around $240 a share. In 2020 is now trading at 92. Okay, so this is a Canadian stock. Looks like the great financial crisis dropped from, yeah. This thing's parabolic. I always hate, I mean, this thing was up. This was like 100 bagger. All right, CJT.to. Oh, CJT. CargoJet. Okay. Free cash flow negative. They're consistently free cash flow negative. That's a red flag. Let's just confirm whether that's true. So their revenues continue to grow. Oh, this thing is growing nicely. Question is how much is priced in. Put this in US dollars. I don't want to read this in loonies. I don't understand it. So $10 a share. It's trading at 90. So 9 times forward. We got to see what is the expected growth rate. CJT. T.to. All right, so they've taken our estimates down. Next 5 years, there's no target. Going to grow earnings 20% next year. Revenues modestly. I will say this. Let's see. Cash from operations. Their CapEx is huge. That I don't love. This is a capital intensive business. So it's like, congratulations, your revenues went up and your CapEx went up disproportionately with that. And congrats on the business and watch out for the loss. That's not my kind of business. Free cash flow negative the last 3 years. I mean, they had two free cash flow positive years. Let's see, not much cash. Let's look at the balance sheet. They only have $5 million of cash. That makes 0 sense. Accounts receivable. How much debt do they have? $500 million? No, not for me. No, I'm going to pass on this. I mean, why would they be so conservative with? Why would they be so have no cash? I mean, you got to double check this number. If this is correct, I don't know. I don't like this balance sheet. I mean, they're growing, but I would get comfortable around solvency risk, start to look at their bonds. They are growing. Everything looks good on that front, but I don't know why they're not holding some more cash on the balance sheet. That just concerns me. So might be interesting. kind of interesting. I know how you got here and I know how you're thinking about it, but I'm a little concerned about that. So if you can get comfort around the balance sheet and the growth path going forward, maybe, but I think they're cutting that a little tight for my level of comfort. Gregory Brink, you did that already. Martin Crumlish, superb BABA earnings today. And in general, the fundamentals of the business seem to be better than ever. I have some in-the-money calls expiring January on top of my core position, which I bought around 83 and 88. Break-evens expiry are 99.50 and 102. I'm thinking about cutting them for significant gain rather than holding to expiry for the next 3 months. As a grind sideways always eats the premium, which is really the basis of my question today. My thinking is I've noticed there's a lack of flows into the general stock market over the last week. We're in the middle of August. Of course, there's a lack of flows. Volumes have been low coming into earnings. I think it's because of Treasury issuance and low lack of general stimulus from China in general. From a headline figure perspective, that is causing funds not to step up. Low general volumes makes you think that day traders... you're overthinking this, okay? Let's see. In coming weeks, core CPI data, blah, blah, blah. Okay, so number one, your question is, what do I do with my options? The answer is, this is all opinion, not advice. I think if you're highly profitable on them and you're deep in the money, I would just exercise and hold the stock and forget about the options. Because, the thing you can't control is, some of these things multiply overnight, like the Cooper Standards and some of those names. But some just take longer. And if you own a high quality business, then you're just in the time arbitrage business and your only risk is your IRR. If it triples over the next 12 months, you got a great IRR if you're in for, 2.5 years. And if it triples over 3-4 years, then maybe your IRR goes down to 22%. And that's sufficient for a lot of people. It's not ideal for some, but that's your real risk. It's not a question of when. So I would exercise them personally. I would exercise them, get out of the options, and just hold the stock as much as I could. And don't worry about options. There's going to be enough money to be made with the stock. That's where I think people get hurt. It's funny. I was talking to two people, and they were saying, "Boy, you give out a lot of value on your podcast." And I said, "You know what? I could give you the 8 to 12 companies we hold at any point in time, or I could give out. I could literally publish my portfolio every week on this podcast. I'm not going to because it's my client's intellectual capital. And I could assure you that on years that were up, having huge year, 55, 65%, more than 80% of the people would be negative, knowing what we own in our portfolio. Why, you say? That makes no sense. Because they haven't done the work and they would be emotionally trading in and out, thinking that they know better. And while the stock was going up, they would be losing money because they would be buying on the rips and selling on the dips out of panic because they didn't have an understanding of the business that they owned fundamentally. I always, I always like to say, I want to overpay for the professionals where the outcome is critical. So I always want to overpay for a heart surgeon or a brain surgery surgeon every day of the week. And, I want to underpay for a landscaper or, a garbage collection service or something like that. It's just comical how people think about the most important things. Like they would never attempt to do neurosurgery because they know mentally they don't have 10 years of experience. They didn't go to medical school. And yet they could hear a stock tip on a bus and put 100% of their net worth that they've been saving up for 20 years into that stock tip. I remember Peter Lynch tells the story. So, the point of that is if you study and you learn, eventually you can become a good investor. But you have to go through experience like any other industry to become the best. It just takes time. It takes experience. It takes passion. It takes intensity. It takes seeing things, all different things and nuances. It's like Buffett says, he did a $5 billion deal in 5 minutes with no due diligence. Why? Because of 30 years of accumulated compounded knowledge. And I look at these things and I'm like, no, yes. And people are like, wait, how do you know that like that? Because I've seen 99% of the situations, and the ones I haven't, I just put in my too hard box. And that's why you never see me buying new stocks or new ideas or any of that stuff, because I can't predict how it'll go. I leave that to other people, and some gamblers get it right and they make 10x, and most of them don't. And they don't write books about the ones that guessed and lost. They write books about the ones that guessed and won. I go for sure bets. I buy durable, sustainable cash flows when they're on sale. They're temporarily marked down, and the franchise has a moat, and it's just due to some temporary exogenous event. And then it's a time arbitrage game. And the question is not when does my money multiply. It's not if my money multiplies, it's when. So that's going to determine the IRR. If my margin of safety, I expect to double or triple in 12 to 24 months, and it takes 24 to 48, well, that lowers my IRR. Which is fine, because I'll have other positions in the portfolio that go much faster than I expect, and will get my, desired IRR net of fees, and have the clients super duper happy, and then manage expectations low, and then beat them. And that's why we don't lose clients. That's really what it comes down to. So, all right, now, okay, so that's the key thing. Forget all the CPI nonsense and garbage. Just own the stock. Don't play around with options. You're profitable on your options. Exercise what you can into stock, so you don't have to think about, well, will it go to 120 or 180 by January? I mean, who the hell knows? You could get a headline that Biden and Xi are now best friends and the thing goes up to 200, or you can get a thing where they circle a boat around Taiwan and it goes down to 80 and we buy more. So who cares? But by the way, one guy, it's funny, at the Money Show, it was so amazing. But so after my presentation, I was really humbled and taken back. Like, they asked me to go stand in the back of the room in case people wanted to come see me. And literally 25 or 30 people came to see me, which I was really honored. And a lot of them, 14 of them, I'm cuffing that. Probably a third of them were people that say, I've been listening to your podcast for 2 years. I've been listening to your podcast for a year. And I'm so humbled that they came up to say hi. They came out to the Money Show to see the Money Show. I'm glad they were able to see me as one of the speakers, and I'm sure they got plenty of value from the other 3 days as well. But that was that. But I had one guy come. Well, what happens if China? What happens if China invades Taiwan? I said, let me ask you a question. What is the largest position in your portfolio right now? And he said, Apple. And I said, well, what do you think happens if China invades Taiwan? What do you think happens to Apple? And he thought about it for a minute. And he's like, oh, it probably goes down 50%. And what do you think happens to the S&P 500? He's like, yeah, it probably goes down, 35, 40%. I'm like, well, you have your exact answer. So if you're worried about Alibaba being cut in half if China invades Taiwan, you got a lot more to worry about with the rest of your portfolio. And the answer to the question is it's mutually assured destruction if they move in that direction. It's not to say it can't happen. It's possible it can happen, but it's possible you can get hit by a bus walking across the street tomorrow as well. You have to manage risk. Look, if we knew for certain nothing bad was going to happen, we'd be double levered, 250% Alibaba, and we wouldn't have 8 to 12 positions. We'd have one levered to the hilt. But we don't play that game, and we manage risk because there's always the possibility of what you don't know that you don't know. But you have to step back dispassionately, weigh the probabilities, manage risk by sizing, and when you have a high level of confidence, also have a limit on that. But for us, this thing, as we said in the presentation, we've never seen it. This is like the apartment building that is getting 8 times the rent it got when we bought it. And people are still making me offers for the same price as I bought it 8 years later. And I just know that when the market cycle changes, they're going to offer me 15 times what I paid for it. And that's when I'll help them out. Hi, Tom. Thank you for taking questions and sharing your insights. It would seem that biotech and pharma may be key, maybe sectors due for growth in the near future. What are your thoughts on Medtronic? Seems very high quality business, trading significantly below value, PE below industry comparisons. Love to get your take on it, Martin. All right, let's take a look, Martin. I think I like this one. This is very similar to Baxter, which we own. All right, so that's Baxter. And this is Medtronic. I think we bought Medtronic because it had a larger margin of safety and it was down more. But this is basically the same trade. It's just not down as much. So instead of making double or triple our money in this thing, you'll make 50%. That's basically the core difference, but we can take a quick look at it. So earnings have been flattish for the last 3 years. Cash flow is flat. High single-digit compounder. Sales growth flat. So yeah, I mean, I think you probably make 40-50% over the next couple of years with this. You collect a little dividend, you sleep well at night. Nothing wrong here. I think you're okay. Next is Felipe Andrew Pincos. I want to express my sincere gratitude for producing such an insightful, informative podcast. Thank you. You're welcome. Thank you for writing that. I'm a huge fan. I've been an avid listener for quite some time now. Thank you. I'm grateful for your consistent support. As a dedicated listener of your podcast, eager to discover other public figures who, like you, are producing exceptional content in the realm of market analysis. Believe that learning from multiple perspectives can enrich our understanding and approach the markets. Hence, I'd be extremely grateful if you could share some recommendations of other podcasts, VideoCasts on YouTube, any other platforms where financial experts or enthusiasts produce content that you admire and find valuable. I look forward to exploring the content recommended by you. So I did a video. You go to YouTube under Hedge Fund Tips channel and just search University of Birmingham. I did suggestions for new people in the business. The number one thing I would read, I always go to source material personally. I like to go to the public filings. I like to go to the public conference calls, the transcripts, all of that, the books, Security Analysis by Ben Graham, Intelligent Investor by Ben Graham, and then every single annual report, annual letter that Warren Buffett has ever written, not only as a public company, since the late 60s, early 70s, but also his partnership levels when he was running his basically separately managed accounts at 0 and 25. Where did I get that idea? No management fee, just a performance fee. I learned from the best. Those would be my best things. As far as people's take on source materials, I think Howard Marks is pretty good over at Oak Tree. I don't really consume a lot of secondhand material. I go to the source. I think Tom Lee's stuff is pretty good. I think Seth Golden is worth a follow on Twitter. I think Ryan Dietrich puts out good stuff. But I would just go to the source. Go to the source, learn from the masters, and you'll be well set. And then if you're young and you want to get into the business, start reading the CFA books and doing that. Learn about companies, read annual reports. Like Buffett says, read 500 pages a day. 500 pages, he does 500 a day, but read as much as you can every week, whether it's annual reports. Some of the daily reads that I put out are pretty valuable. Etc. Don Williams, I found you on TikTok and I am old. Okay. I was wondering what you think happens if inflation begins to creep back towards the 4 or 5s. I'm a bull with you, but I'm still holding stocks like Meta from 105. My only worry is inflation coming back. So what do you think the chances of inflation coming back, and what do you think if it happens? It's possible, not probable, based on the numbers I'm looking at. You could have short-term spikes. I don't think this is the 70s. I will say that the Fed funds rate in the late 90s got up to 6%. We're at 5%, and you had the biggest tech rally the biggest rally in the shortest amount of time in human history. So it doesn't necessarily mean it would crash things. I just think this is different, and I think we're okay at 5.5 or 5.35 effective rate. I think that's more than sufficient. I think they can keep skipping, and if it pops up, they do a 25 bip here and there. But you got the lagged effect. the issue would not be inflation popping back up, because we do need some inflation to take the debt to GDP numbers down. The issue would be if they overreacted to it. That's what would concern me, and that you can't handicap other than seeing what they do and acting accordingly. But the businesses that we've been buying have such a margin of safety created by a once in 100-year event that, even with 8% rates, like, these businesses are so cheap relative to what their normalized businesses are going to look like coming through all of this, that, it is what it is. I think that they have the tools if it rears up again, but I think it's a low probability at this point. I think the rents that you're seeing going negative and that work on a lag basis are going to continue to put pressure. Yes, some commodities are popping up because we've had some poor energy policies, but high prices cures high prices. I think that supply can come on pretty damn quick in the U.S. and elsewhere, and I think we'll be okay on that. Just keeping an eye on rents, and the numbers today were very, very constructive on that front. So, with that said, I'd like to thank everyone for tuning in back this week. As always,